Right now, as of 10:13 a.m. Eastern Time on this Thursday, November 13th, shares of BigBear.ai Holdings, or ticker BBAI, are trading at $6.69. That is a sharp move down, a drop of about 6.7% for the session, or 48 cents. The stock gapped down at the open from yesterday's $7.17 close and has been under pressure ever since, hitting a low of $6.57 on very heavy volume, already approaching 20 million shares traded in the first hour. This move is catching a lot of people by surprise. Just this week, BBAI was the talk of the town, soaring on what looked like a fantastic combination of news. The expectation, the narrative that has been building, is that this company is a mini Palantir, a pure-play AI company, perfectly positioned to capture massive government and defense contracts. That belief seemed cemented just 2 days ago, on November 10th, when the company reported its third-quarter results. The headline numbers were, by all accounts, a beat. The company posted a net loss of just 3 cents per share, which was significantly better than the 7-cent loss analysts were forecasting. On top of that, they announced a major transformative acquisition, a $250 million deal to buy Ask Sage, a generative AI platform specifically designed for defense and government clients. This, the market believed, was the missing piece. This was the catalyst. The stock exploded in pre-market trading on Tuesday, running up over 20% as investors piled in, assuming the path was clear for a move to $8, $9, or even $10. The expectation was that an earnings beat plus a strategic acquisition equaled a sustained breakout. But today, the reality is setting in, and it's a cold one. Today's 6.7% drop isn't just a minor pullback, it's a violent rejection. It suggests that the reality of BBAI's situation is far more complicated than the bull narrative allows. The stock couldn't even hold its gains on Tuesday, closing up only 6.8% after being up 20%. And now the selling pressure is accelerating. This forces us to re-examine what the market was so excited about. That earnings beat? It looks good on the surface, but when you look at the top line, the story changes. Revenue for the quarter was $33.1 million. While that did beat the consensus estimate of $31.8 million, it represents a 20% decline from the same quarter last year. A 20% year-over-year revenue drop is not typically what you see in a high-growth AI company. The company is managing its bottom line better, yes, but the top line is shrinking. Furthermore, the company's gross margin actually compressed by 350 basis points to 22.4%, and its adjusted EBITDA, a key measure of profitability, flipped back to a negative $9.4 million. This is the reality that is fighting the expectation. The company is not growing, it is shrinking, and its core profitability weakened. So why the pop? It was a combination of a low-bar earnings beat and the Ask Sage acquisition, which is where the bull case now rests entirely. The Ask Sage deal is, on paper, a very smart move. It's a generative AI platform with over 100,000 users across 16,000 government teams. BBAI management stated this acquisition will add approximately $25 million in annual recurring revenue. This is significant. For a company that just posted $33 million in a quarter, adding $25 million in recurring revenue is a major boost, and it directly addresses their weakness in the generative AI space, positioning them to compete for larger multi-year contracts. The company even raised its 2025 guidance to a range of $125 million to $140 million. The bulls look at this and see a company completely repositioning itself for the future. The bears, and apparently the traders taking profits today, look at this and see a company paying $250 million for $25 million in revenue, a 10-time sales multiple, while its own core business is declining 20% year over year. They also see the potential for dilution to pay for this deal, or the strain on the balance sheet. This tension is the entire story of BBAI, and it's playing out in real time in the trading data. This stock is not being traded on fundamentals alone. It is a battleground. This becomes crystal clear when we look at the short interest. As of the most recent data from Fintel and the exchanges, the short interest as a percentage of the float is hovering around 18%. That is an exceptionally high number. 1 out of every 5 shares available for trading is being held by someone betting the price will go down. This is what fuels the next squeeze narrative on Reddit and X, where BBAI is constantly compared to Palantir. Retail investors see that 18% number and believe if they can just coordinate a buy, they can force the shorts to cover, sending the stock flying. But this is where investors need to be extremely careful and look at the whole picture, not just the data point that fits their bias. Let's look deeper at the short data, because this is where the real story is. What's your take on the 18% short interest? Is it smart money identifying a flawed business, or manipulation trying to suppress a recovery? Here's the data. While the 18% short interest is high, the days to cover is less than 1. It's sitting at 0.97. This metric measures how many days it would take for all shorts to exit their positions based on the average daily volume. A number below 1 is incredibly low. It means that with the massive volume BBAI trades, we saw 156 million shares on Tuesday and 19.7 million already today, shorts can get in and out of their positions with extreme ease. A sustained squeeze is very difficult because there is no panic. The exit door is wide open. But the most telling statistic is the short borrow fee rate. This is the interest rate shorts must pay to borrow the shares. For stocks that are truly hard to find and in high demand by shorts, this rate can skyrocket to 50, 100, or even 200%. For BBAI, the borrow rate is currently 0.56%. That is not a typo. It is near zero. This tells us that large institutions are not holding their shares tightly. They are more than happy to lend out their shares to short sellers for a tiny fee. This is not the profile of a stock on the verge of a historic squeeze. It is the profile of a stock that institutions are comfortable betting against. Investors can and should track this data themselves. You can get short interest data from FinViz, Fintel, or directly from the exchange reports. You can track the off-exchange short volume, which for BBAI has been high, about 40% on recent days, meaning a lot of this shorting activity is happening in dark pools, away from the public lit exchanges. This can, in fact, suppress the price discovery. You can also look at the fails to deliver data, which did show a significant spike in late September, with over 1.8 million shares failing to be delivered on one day. This indicates potential issues with settlement and naked short selling, but it has since subsided. The actionable takeaway here is that the short thesis is not just it's a bad company. The short thesis is that it's a company with shrinking revenue, negative EBITDA, and a high beta, 3.42 stock, that is being driven by retail sentiment, not by financial performance. The Ask Sage acquisition is the one tangible counterargument, and the shorts are betting it won't be enough to justify the current market cap of over $2.9 billion. So, who is right? The analysts who cover the stock are completely divided, which perfectly reflects the market. We have H.C. Wainwright, who just reiterated a buy rating with an $8 price target, believing in the Ask Sage story. But on the other end, you have Weiss Ratings, which has a sell rating. The consensus price target from the few analysts who cover it is around $6.33, which is significantly lower than where the stock is trading right now, even after today's drop. This is a crucial data point. The professional analyst community, on average, believes the stock is currently overvalued. Let's briefly touch on what BigBear.ai actually does. The company provides AI-powered decision intelligence solutions. Its platform is built to help clients, primarily in the U.S. defense and intelligence communities, make sense of massive, complex datasets. They use terms like observe, orient, dominate to describe how their products give their clients a competitive edge. This is why the Palantir comparisons are so frequent. They operate in the same high-stakes, government-focused arena. The company has secured numerous contracts with the U.S. Army and Air Force, focusing on data analytics and predictive systems. The problem, as evidenced by the 20% revenue decline, is that these government contracts can be lumpy, and some projects may be winding down, as one report noted, with reduced activity from the U.S. Army. This creates a show-me story for the company. They must prove that the Ask Sage integration can not only plug this revenue hole, but also create new sustainable growth. Looking ahead, the path for BBAI is volatile. The bull case is simple. The Ask Sage integration is a success, and its $25 million in recurring revenue is just the start. They leverage this new capability to win larger defense contracts, revenue stabilizes and begins to grow again, and the 18% short interest is forced to cover, sending the stock toward its 52-week high of $10.36. The risk, as noted in a recent report, is that external factors like a potential U.S. government shutdown could temporarily pause part